financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rahaim.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rahaim. Hi.
Hi, Jess. How are you?
I'm great and always happy when we've got a guest for the show.
Look who we have.
I know, a returning guest.
Hi, Ben Braverman.
Hey, Francis. Hey, Jess. How are you?
Hi.
So we've had Ben Braverman before, and he's always got a lot of great advice, or maybe good things to say. I would say he's not giving you advice. Be careful about that. But he is a senior marketing consultant for SMS Financial Solutions. And Ben and I work very closely together to find solutions for people. He doesn't earn commissions. He's not here to sell you anything. It's a real boon that we can get him on the air to talk about these things, because what you're getting here is the inside scoop, all the stuff you would never gain access to as a standard investor or, a typical client without this kind of a show. So welcome, Ben Braverman.
Great to be here. It was a lot of fun last time, and I'm really looking forward to diving in today. There's certainly quite a bit to talk about.
We are such geeks. It was a lot of fun.
Digging in on some annuities all day, every day. That's it's a good time.
Well, I guess the reason I'm sort of laughing is because there comes a point in the market where you either have to laugh or cry, and I will choose laughing. Turmoil, no great way to make a plan, it seems, and people are worried. People are acting out of fear sometimes. And we've just gotten some more news today, which I won't bring up, but more news, as we get almost every day, of something else that's going to throw the market into a tizzy. So, if you're 25, you ride it out. If you're 64, you're worried. So I wanted Ben to come on and talk with me about what to do right now in this market if you are at or near retirement, because there are things you can do. Right out of the gate, let me just say, the market doesn't care if you're retiring. Don't worry, the market will come back. It's a paper loss. Let me tell you, if you're 64, that's not a paper loss anymore. That's your grocery budget at 74. Let me know what you think then about, are we in a U curve, a V curve, whatever? And let me preface this for our listeners by saying, Ben will speak in his language. I will do my best to translate into standard fare, accessible language that we all speak in. But in parlance, go ahead, Ben.
So you brought it up. We don't know if this is going to be a U curve or a V curve. So a V curve means the market's going to come back really, really fast and stronger than ever. A U curve could be a much longer, a little bit more sustained period of time of pain, which is what it is. It's painful, right? It's painful to see those losses. But for me, as someone in their late 30s, when I see my portfolio go down, I know I have 20, maybe even 25 more years, if not a little bit longer, in my retirement horizon. I have plenty of time to make that money back. To your point, if you're at or near retirement and your 401k is looking more like a 201k, well, that could be a real cause for concern. Now, humbly speaking, and I'm sure you've gotten some calls from clients already, for clients already in safe money strategies, they're not worried about this at all on that portion of their portfolio. And that has to feel really, really great. And that makes me feel really good about the products we facilitate on a daily basis, because they indeed work. But what we're starting to see already is people, in response to all this market volatility, in response to this perception of pain, they're saying they're not making any decisions whatsoever, or what's even worse is they're locking in their losses and moving entirely over to cash. So
thank you. Locking in your losses.
I
hate to interrupt you, but I want to hang on that phrase.
Please do.
For just
It's your
a second.
show.
Locking, it's our show today.
Our,
Locking in your losses. Let's talk about that for a minute. First of all, I said I'd translate V curve, the letter V, U curve, the letter U, not a YOU curve. The market is not ever giving us a YOU curve, okay? So so that's just about what a chart would look like. You know, a stock chart would look like if you looked at a V versus a U. It's going to take longer to come back out of a U than to hit the bottom in a sharp point and come back to the top of a V. Locking in losses. When people panic and they say, oh my gosh, look at my 401k is losing money or my IRA or my, it doesn't matter what it is, your mutual fund, your investments are losing money like crazy. You want to stop the bleeding. You pull the trigger. You say, cash out my account. I'm just going to put it in the bank or put it in a CD or put it in cash somewhere. And I know I'm not going to have any losses. That is a logical thing for most people to come to as a decision. Stop the bleeding, get a tourniquet, call it done. Okay. But when you don't know what you don't know, you have locked in your losses instead of locking in a comeback. What would happen if you could lock in a comeback? So I bet Ben knows where I'm headed with this, but I'm going to just say I'm talking specifically right now about an indexed annuity, right? So Ben, can I kick it back to you and get your thoughts on locking in a comeback versus locking in losses?
I really like that locking in a comeback term because to your point, there's no guarantee of when the market is going to come back. What is guaranteed, though, is the guarantees right now on safe money strategies, i.e., indexed annuities, in the form of guaranteed income or upside accumulation. Let me give you two examples. One example might be your portfolio's down 10%, maybe even 15%, because hopefully it's diversified and you weren't all in seven stocks or all in one S&P 500 ETF. But let's assume your portfolio is down 10 or 15%. There's strategies on annuities right now, on safe money solutions right now, where you could get a 15% premium bonus, as in a 15% actual bonus on your cash value to recapture those losses, or maybe even come slightly ahead. And from there, these indexes are not totally invulnerable from a down market, but you don't experience any more of the downside. And when the market starts to come back, which it totally and inevitably will, right? From 2008, if you had losses in 2008, the comeback was in 2009. But we just don't know what that time horizon is going to be. So you could, as you just said, stop the bleeding, recapture your losses with a bonus, and then after a period of time, zero is going to be hero for a period of time. You may not gain anything, you may not lose anything for a few months or even a year, but when the market inevitably comes back, you will start participating in that upside. Will you participate in the same upside as you would as if you were directly invested in the market? No, but if you're at or near retirement, are you still trying to swing home runs? And if you are, then you kind of need to think about realistic expectations for your cash flow and for your life savings, because the time to be hitting home runs is not when you're about to be in the seventh, eighth, or ninth inning. That metaphor got a little mushy, but you get what I'm saying, which is if when
Yes.
you're at or near retirement, that's not the time where you should be trying to experience exponential growth in the market, because you also don't want to be experiencing exponential downside, which is what you could be experiencing right now if you don't de-risk your portfolio. That's on the accumulation side. But the other side is guaranteed income. And let me,
Wait, wait. Too much, too fast, Ben. Hang on.
sorry,
Okay, we are coming back to guaranteed income for sure, but let's just chew on that for a second for our regular listeners who maybe are not financial pros. Okay, what did we just talk about? If you cash out of your account and you stick it in the bank, or I don't mean to pick on banks, I like banks, but you put it in cash, then you have locked in those losses because you've turned what were paper losses into real losses with no guaranteed comeback, right? No guaranteed amount of earnings. You haven't recouped your losses. You've just taken the lower amount and stuck it in cash where it's going to earn a lower interest rate, most likely. All right. When you use an indexed annuity for this, and there are many different types. I mean, gosh, there's so many different indexed annuities. It's why it's important to work with a pro. But when you choose an indexed annuity, let's choose the one that Ben is talking about, the kind that has a premium cash bonus up front. That means you take let's use $100,000. You take $100,000, you throw it into this, and it becomes $115,000 overnight. Real money, right? Real money. So you've
That's
just
exactly
recouped
right.
probably what your losses were, and you're not going to experience every market high from now on, but you also won't experience any market downside risk, right? You're protecting your principal and you're getting interest based on what the market is doing with your particular buckets in your annuity, right? It gets complicated. But what you're looking for here is growth potential without the downside potential. So in terms of growth to growth, here's your portfolio that you're losing money in and you're trying to cash out of and you just want to stop the bleeding. What are you going to do with that money? You can either lock in your losses and stick it in cash, or you can lock in a comeback, recoup probably most of your, if not all of your, and then some losses with this premium bonus, and then have upside potential in the future. Will you get the whole market gain? No, but you won't go backwards either. So if you think of it like a ratchet, instead of going straight up, yeah, you're going like this, but you're not worried about it. Zero is hero. What Ben was saying is, in a really bad market, you're going to be happy to see a zero on your annuity because everybody else is seeing a negative. So, all right. So I didn't want to cut you off, but I just wanted to drive home that idea of the growth part of this, because we have to talk about income, and we will definitely do more of that in the second half too. But let's go back to Ben for more about this growth part. If you can explain maybe a little bit about caps, spreads, fees, like a rider fee. Give me some of that information. We can always expand on it.
So the guarantees on indexed annuities with respect to the amount of participation that you get in index upside, because you're not really invested in the market. So let's just call it index upside. The amount of index upside you get now is better than it's ever been. Why? Interest rates. The 10-year treasury determines a lot of the pricing for indexed annuities.
Yep.
To put that in perspective, in 2020, when we were doing hundreds of millions of dollars of annuity transactions, because retirees do need and want guarantees, the 10-year treasury was at 60 basis points, which is a fancy way of saying 0.6%.
That's right.
Today, the 10-year treasury is around 4.3%. What does that mean? Insurance companies have a lot more yield that they're able to pass on to the consumer. To give an idea of how that yield creates a buying opportunity for consumers, in 2020, those bonuses we were talking about, you maybe saw a bonus for 7, maybe 10%, maybe. Now you're seeing bonuses as high as 15, even 22% in the industry. I've
Cash
never
bonuses.
seen these
Real
are
cash
cash
bonuses.
bonuses. This
Right.
is real cash bonuses.
Wait till we get to income.
So interest rates right now, they're not helping if you have revolving credit card debt. It's not helping if you want to get a mortgage. But if you're at or near retirement and you're in the annuity market, this is a buying opportunity for annuities. So while you might enter an annuity at this time at maybe even a small loss, the long-term guarantee that you're locking in the form of index upside or the income guarantees that we'll get to in a little bit, that's guaranteed right now. Because here's the other thing about trying to wait out either your cash value to come back in your market-based 401k, 403b, IRA, Fidelity account, what have you, waiting for that to come back, you could wait out the guarantee. What do I mean by that? Interest rates could come way down, and then the great solutions that we have, they'll still be pretty good, hopefully, because I don't think interest rates are going to go back to where they were in 2020 anytime soon. But right now is a buying opportunity. So while you might have a small loss, you could have a great long-term upside gain by leveraging the high rates that are available in the annuity itself. It's kind of like, to put it in perspective, if you went and shopped for a 12-month CD 5 years ago, it was way lower than it is right now. Now, I wouldn't advocate for a 12-month CD right now because after taxes and inflation, you're barely making a point of gain anyway. But what I'm trying to do is give some reference for where interest rates are at. So is there any guarantee when the market is going to come back? No. But is there a guarantee right now that you're going to get some of the most highest index upside, highest bonuses, and largest benefits that we've ever seen in safe money strategies? That I can say is compliance, hear me roar. That is a guarantee, right?
That's
That is
right.
a 100% guarantee. So
That's
I
right.
really hope people don't miss out because they're concerned, rightfully so, and because maybe even a little shocked because it's been a while since we've seen this much volatility, that they sit on the sidelines and miss out on a buying opportunity for their future accumulation in retirement.
Yeah, completely agree. We are going to have to go to a break in a minute, but I just want to make sure that people are clear on one thing. When we're talking about the 10-year treasury was at 0.6% and now it's at 4.3%, we aren't saying that that's what you're earning in your annuity. The indexed annuity, your earnings are linked to the market, but not invested in them. What you can use those numbers for is to understand the difference in growth that has happened during those times and why an indexed annuity right now is so appealing, right? Based on the 10-year treasury. So when we come back, I know Jess will get us to break, but will you talk to us about income when we come back?
That sounds great.
Okay.
All right. In the meantime, I can imagine there's a lot of financial questions out there right now. So can we get your phone number, Francis?
Of course, Jess. It's 413-773-3333.
And you can also visit hugyourmoney.com. We'll be right back with more from Ben Braverman and also the Money Doctor, Dr. Francis Ram, right here on WHMP.
Financial Fitness with the Money Doctor is underwritten by Franklin County Technical School. We build futures. Visit fcts.us or call 413-863-9561.
Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Ram, and our guest today, Ben Braverman. Hi.
Hi, we're back with Ben Braverman from SMS Financial Solutions. He's a senior marketing consultant, not here to sell you anything, but here to give us the skinny inside scoop on what you can do if you are at or near retirement and you're riding this crazy market. So welcome back, Ben.
Great to see you, Francis. Great to see you, Jess.
Thanks. Just before the break, we were headed into talking about guaranteed income. Indexed annuities, which is what we're talking about, is a way to lock in a comeback rather than lock in your losses if you want to move money out of the market right now. There are many varieties and they get complicated. But for our purposes, we've sort of divided them into two sections. The first that we talked about in the first half is what if you just want to recoup your losses from the market and you want to get a cash bonus up front. And we're seeing products right now, A+ rated products, right, up to 22% cash bonus, which means if you've lost 15% in the market, you're going to regain that plus a little bit more by moving to this kind of an annuity. They're not for everybody. They have some fees. We'll talk about that. But the second kind of an annuity that I think is so important to people who are at or near retirement, or even a little further out because they're wanting to build this product for that date, is the income, the guaranteed lifetime income. So I want to start that by saying, just think for a second about what it would feel like if you're a retiree or a pending retiree. What would it feel like to have a check show up every month, regardless of what's happening on CNBC? That's what to think about right now. So Ben, let's talk a little bit about the income.
Totally. So you articulated, and I think we've spoken about it on previous shows, but retirement used to be a three-legged stool: Social Security, savings, and a pension. Now less than 23% of retirees have a pension in retirement. A fixed index annuity with an income rider can give you a private pension in retirement, an unequivocal guarantee of paychecks in retirement that will never run out. Perfect, right? Again, where is the money coming from that we use to fund these types of strategies? It's 401ks, it's IRAs, 403bs, etc. A lot of those accounts are down right now. So much like on the accumulation side of the ledger, we're seeing clients, because they haven't experienced this level of volatility in quite a while, saying, you know what, I'm going to hold out. I want my 401k to regain that 10 or 15 or even 20% until I roll it into this strategy. I feel like not always, but often that's going to be to their long-term detriment. The reason that's going to be to their long-term detriment is to go back to that 10-year treasury real quick. The guarantees for income have never been quite as high as they have right now, have never quite been this high. To put that in perspective, 2020, when the 10-year treasury was at 0.6%, one of our core carriers provided a 10% premium bonus with a 7% compounded roll up. I'm not going to try to explain what all that means, but that means that if you put in maybe $100,000, you are going to get back, let's say $5,000. So like 5% of your money on a
Per
guaranteed
month.
basis
Per month.
well, annually, 5,000, 5,000.
$5,000 a month on an
Yeah.
annual basis, right? Yeah.
So, but then here we are in 2025, that same strategy
Wait, Ben,
offers,
I'm sorry, I have to go back. I just said
you said
$5,000 a month on an
5,000 a
annual
month,
basis. We have to correct that. I'll
5,000
just
on
clip it
an
after you said annually. I'll just cut myself out.
5,000 annually. So that's about 5%. That's not a bad bang for your buck, right? Getting 5% of your money back no matter what. But think about this for a second. 10-year treasury is 4 times higher, 5 times higher even than it was back then. It's exponentially higher. It's at 4.3, 4.2%. So that same bonus is now 30% with a 9.5% roll up.
Yeah.
Again, roll ups, bonuses. Let's talk about what you're getting back. You could be getting back 8, 9, or 10% of your money on a guaranteed basis annually. But that's because interest rates are so high right now. So the other week, I was working with an advisor on a case where the client's account had declined by $30,000. It was like a $600,000 account, but she was actually moving from a variable annuity to an indexed annuity. A variable annuity are subject to market losses, an indexed annuity or not. They both had guaranteed income riders. Even after the $30,000 cash value loss, she was still going to get 11% more in guaranteed income by staying in the indexed annuity as opposed to the variable. The advisor really had to talk her through it because that $30,000 loss, paper loss, real loss fundamentally is really scary. But what he outlined and what I would outline as well is what's even scarier to me is missing out on a lifetime guarantee of 11% of your money back in her case on an annual basis. So it would be terrible for anyone to see these short-term losses and miss out not on a long-term cash value gain, but on a long-term income guarantee in the form of the private pension and retirement.
Is there
I,
an amount that makes sense though? Like you guys are talking about an indexed annuity. Does that work if you have like $100,000 or $50,000, or is there a level where it doesn't really make sense because you don't have enough to get any kind of a good guarantee back? Does that make sense, that question?
I'll field that one. Um, so
Francis speaks my speak. Here we go.
some of these products have minimum amounts that they will accept money at, 10,000, 25,000, that kind of a thing. You don't want this for your whole portfolio, just like you don't want anything for your whole portfolio. Does it make sense to you? One product might make sense when another one might not. For instance, if you only have $20,000, maybe you want to go into a bonus product that gives you a cash upfront bonus because the income, if you're close to retirement, might not be enough to
Hmm.
be appealing. But that's why you need a pro to help sort those things out. It's not that there's an amount of money. I think Ben would agree with me on this. It's not that there's an amount of money that makes sense, but it's like anything else. The more money you have, the better this is going to work for you, right? Because
Hmm.
it's big numbers. Um, I want to go back to for just a second to this roll up and bonus thing that Ben was talking about. He said, I'm not going to try to explain it. I'm going to give a brief rundown. A roll up is the interest rate that you're going to make each year. Now, that product that Ben was talking about, I know that product well. And that 9.5% means that by contract, they will pay you 9.5% a year, plus that 30% bonus he's talking about, guaranteed in the contract for 12 years, the 9.5% for 12 years, or until you turn actual income on. Those are details we'd have to go over, right? But those are written in guaranteed terms for the purposes of income. That's not, hey, I'm getting 9.5% a year. I'm going to walk away with that in cash. You want to walk away with the money in cash. You want the first kind of an annuity we were talking about with a real cash bonus. But most people will take the money out of their annuity over a stream of lifetime income because otherwise they get hammered on the taxes and because they need lifetime income they can rely on. What you're doing with these is privatizing your own pension. That's the purpose of this, and locking in the gains to boot. Ben, I want to come back to you before I get too chatty. So we are talking about turning risk into a reliable income by way of using an indexed annuity. So can you talk a little bit about maybe a product that might have an increasing income option to ward off inflation or something like that?
Yeah, so we have the ability to leverage strategies to peg income either to the consumer price index for inflation purposes or index step-ups, whereby there's functionality inside the rider, inside the income benefit, to look at the performance of the contract value and allow that when we do enter upside index territory for you to even get a raise on your existing guarantee. Where you're guaranteed not to get a raise, though, is if you keep your money, all your money, not some of your, but if you keep all your money in the market and say you're saying, I'm going to withdraw 4 or 5 or 3% for the rest of my life, who wants to withdraw 3 or 4% from a diminishing asset? That number's probably only going to get smaller, right? If you're even going to keep up with it. On the flip side, if we enter a really sustained bear market, if things get really dicey for 2, 3, or 4 years, your income stays exactly the same, even if your cash value goes down. And it's in these types of market environments when we remember that not everything is up and to the right, where you and I and the consumers that have these strategies know that value. But here's an opportunity to remind consumers this is an enormous amount of value. And again, this value is tied somewhat, if not very much, to interest rates. So again, this is a buying opportunity. Just like I wish I could have bought Netflix or Apple in 2008 when they were really, really cheap. If I were at or near retirement and I could lock in 9 or 10% of my purchase payment in the form of income on a guaranteed basis, i.e., I put in $100,000, which we just use that for a round number, and I'm going to get back in 2 or 3 years $10,000 for my entire life or for my life and my spouse's life, no matter what happens in the lower right-hand corner of my TV screen. I'm talking about the market returns. Right. That's a buying opportunity for someone at or near retirement. So again, please don't sit on the sidelines. Capitalize on these guarantees while they're here.
If you're drawing money from a declining asset, you are amplifying your losses.
That's right.
And, you know, these are not for everybody, but who they are for people near or at retirement, people worried about recent losses, and people who don't want to risk their income on hope going forward. I just want to thank Ben Braverman again from SMS Financial Services for coming on and talking with us about this, and wishing you well. And as somebody who's 61, I can tell you, you betcha, these are a great deal right now.
That's
All right,
great.
Can we get phone numbers for you, Frances?
You bet. 413-773-3333.
And you can also visit hugyourmoney.com. We'll be back next week with another edition of Financial Fitness with the Money Doctor, Dr. Frances Rahaim on WHMP.